The last few weeks with the stock AMC and GME and some of the crypto pumps have been going on, one thing you see a lot of on Twitter is, should I buy or sell? People not knowing what they're doing with the markets. So for traders that are looking for a quick answer to the question whether you should buy or sell, the Momentum Pinball Strategy from Linda Raschke could be something to take a look at. And before you start, I just want you to keep in mind that this is not for any long-term holding, no stock holding for long-term. And it does not take into account the overall trend direction of the market. So why would you consider it? Well, first, we should look at the trading indicators we're going to be using. The first one is the ROC. That's the rate of change indicator. And the setting for this is going to be 1. And that's going to show you the percent change between the current price and the day previous. And what this reading will show you is how much momentum was in the move based on how big a percent change there was. And keep in mind that essentially large moves in a market often result in a snapback in the price. The next indicator to take a look at is the RSI. It's the Relative Strength Index. And we're going to use a period of 3. And the source for this indicator will be from the ROC indicator, okay, from the rate of change indicator. So you're going to need a charting package that allows you to use the output of one trading indicator as the source for another. In this example, we're using TradingView. So essentially what's going to happen is the ROC will give you a percentage change, and the RSI will give you the strength of that change. So then the RSI is going to plot, and then we're going to look at 2 readings. 70 and above, overbought. 30 and below, oversold. Now we need to see either one of those. Okay, anything in between those, we're going to ignore the strategy. And if we find ourselves in either of those levels, okay, this is not an automatic buy or sell signal. We need price action to show us some confirmation that we are in line for a reversal. So here's the strategy for this. So to start with, we're going to use the daily charts, and we're going to use virtually any instrument. So the key is to ensure that the average range of that instrument is wide enough so you don't get quickly stopped out in small ranging markets. So we can use the ATR, and you're going to compare the charts that you want to trade. And you probably want to side on the instrument that has bigger moves on a daily basis. So a buy setup. At the close, the RSI has to be below 30, which indicates, at least temporarily, the market may be oversold. When the market opens the next day, our strategy is on alert for a buy day. So we want to allow that first hour of trading just to play out. Your buy stop order to go long is going to go above the price range that was made in the first hour of trading. Your exit's going to be below the range. If you're in profit during the day, you're going to hold into the next day. Now on the next day, you're going to exit if price is falling, or if the price is trending, ensure that you close by the end of the day. So let's define the 1 hour range. So when you're looking at your charts, you want to map out from 9:30 to 10:30 on your chart. Now, in a shorting scenario, you then look to sell when price breaks the low of that range. Understand that the risk on a trade may be quite large at times. On this chart above, that range is $4. So the rules for sells are just the opposite of the buys. At the close of the market, RSI has to be above 70, and that indicates, at least temporarily, the market's overbought. When the market opens the next day, our strategy puts us on alert for a sell day. You want to allow the first hour of trading to play out. Your sell stop will go below the price range that was made in the first hour. Your exit will be above the range, your stop. If you're in profit for the day, you hold to the next day. On the next day, you're going to exit if price is going against you, or if price is trending, you close by the end of the day. So let's look at some example. This is Groupon. So at the end of each day, you simply look at the RSI. That's the red arrow. And you want to note its position relative to the 70 and 30 level. And during the month of January, Groupon had a total of 4 potential trades. So number 1, you could see at the next day's open, the first hour saw all of that day's range. Okay, there's no break of the high of the range. Therefore, there's no trade on this day. At number 2, got another big move off of the open, but eventually this day moves 85 cents to the downside. Now, I want you to keep one thing in mind is keep your expectations low for big gains. Okay, you want to think of these as more of quick hits because you're only going to be looking to hold for 2 days at the maximum. So does day 3 look any better? Not really. We get 63 cents to the downside, but can you imagine sitting through those long lower shadows? It'd be tough to do. I'm not even going to bother to look at day 4 because I can tell by the daily chart it just went to the upside. You impressed? I'm not, because this is just one stock out of many. This is why you have to use multiple instruments. And for the examples, I just picked random stocks off my list. Okay, there's no sense in showing you the best of the best, but it brings up a good point. Again, use multiple tickers. So if we get big runs at the open, it's quite possible it eats up much of the average range of that day. So by having multiple instruments open, that allows you to pick the best of the bunch for the day. So I want you to imagine you had this stock chart up and the day previous gave you an oversold setup, right? So we're looking to buy. So the first half hour showed buyers in the game. And then from 10 to 10:30, we see sellers step in, and that gave us a small red candle. So what this does do is it decreases the range. And from a price action perspective, this could be setting up for a move higher. Now, following the entry rules, you buy over the high of the range. This trade actually runs $8 to highs. Now, price does eventually drop into the close. You'd eventually take a loss on this trade. What about this one? Now, the day previous was oversold. Okay, so we're looking to buy. So if you had this chart up on the trading day, you'd notice the small opening range for that first hour. And while price did trade below the range, remember that we are looking long because we were in oversold. So price rallies, our entry is hit, stop loss goes below the range. So stop on this is just under $1 a share. Price did nothing for the rest of the day, but we are in profit at the end of the day. Remember the rule, if you're in profit, you hold. So we hold through the next day, we have a gap up, and then we get a $7 run to the upside. Okay, so now remember, we're looking to profit off of quick hits in the market. Okay, but there will be times that these runs like this come out of nowhere. So how can we improve it? Well, one of the biggest things you got to do, and to make this more reliable and worth trading, is to watch how big that opening range is. If it's too large, the risk is pretty big on the trade, right? So it's going to affect your position sizing. I personally could not imagine using an $8 stop on a stock trade. Trading multiple instruments is vital to this. And it allows you to pick the best looking setup in the morning. And you may find that in your testing, that an oversold level of 30 is actually less reliable than an oversold level of 20. You may also consider using trailing stops as the day progresses, locking in your gains. And we saw that earlier when that stock was up $8 and then it turned into a loser at the end of the day. Now, keep in mind that any deviation from an original strategy, it's not the original strategy anymore. Right? We've seen too many traders over the years make changes to a method. They'll still call it the method and then complain about the method when it fails. Okay? So if you change any rules, it's now your method. I do like how fast you can scan for possible trades, and that during the morning you can actually shrink down that list depending on the price action in the first hour. And I say this all the time, risk management. As we saw with GME, we saw with AMC, traders have just abandoned risk protocols to get rich quick. Okay, long term, it's never going to work. Appreciate you watching. Hit like, subscribe. Any comments, questions, pop them below. And as always, I'll respond. Talk to you soon.